Hello and welcome to Earnings Echo. We put together the most important information about Salesforce.
Glad to be here for this one.
Yeah, so today we're looking at what seems to be a massive financial illusion. I mean, on paper, the market thinks this tech giant is shrinking by like 3% a year.
Right, which sounds terrible.
Exactly. But under the hood, their new AI revenue just exploded by over 200%. So let's figure out why the math looks so broken right now, starting with the Q1 FY27 results.
Sure. So looking at the headline numbers, Q1 revenue hit $11.13 billion. That's representing a really solid 13% year-over-year increase.
Okay, 13% is solid. What about the bottom line?
While non-GAAP earnings per share came in at $3.88, which is, a massive 50% jump from last year. Plus, they actually raised their full-year FY27 revenue guidance to a range of $45.9 billion to $46.2 billion.
Hold on a second. A 50% EPS jump sounds spectacular on the surface, but we really need to look at the mechanics there.
You're talking about the share buyback.
Exactly. Didn't they just execute a $25 billion accelerated share repurchase program? Retiring 103 million shares up front is obviously going to artificially juice those per-share earnings.
Yeah, it definitely did. It absolutely inflated the EPS.
So what do the actual underlying operational metrics look like without all that financial engineering?
Well, the operational strength is actually still there. They posted a record 34.8% non-GAAP operating margin.
Wow, almost 35%.
Yep. And under their newly disaggregated revenue structure, which basically isolates their AI performance, Agentforce apps generated $6.9 billion in revenue alone.
Okay, but no quarter is absolutely flawless. I mean, where is the friction? We can't just ignore the legacy business segments.
Right, the friction is definitely there. The main headwinds are in marketing and commerce, which just continue to show weakness.
So those older tools are dragging a bit.
Exactly. We're also seeing increased softness in Tableau, specifically with new bookings and renewals.
Interesting. Are they just eating those losses?
Well, right now, those organic declines are actually being masked by the top-line revenue brought in from the recent Informatica acquisition.
I see. So with that mix of massive AI growth and, legacy softness, you'd expect management to be a bit defensive on the call. But the tone was aggressively bullish, wasn't it?
Oh, incredibly bullish. They keep hammering this transition to what they call an agentic enterprise.
Which, to translate for you listening, means moving away from traditional software that just organizes your data. Instead, it's moving toward AI agents that actually execute tasks automatically. Are the numbers backing up that confidence?
They really are. Management pointed to a record 98 deals over $1 million this quarter.
$98 million deals, that's huge.
Yeah, and more importantly, Agentforce annual recurring revenue grew 205% year over year. It hit $1.2 billion.
Okay, so that's the lifeblood of that agentic enterprise transition right there.
Exactly. And they're using those specific metrics to firmly commit to an organic revenue reacceleration in the second half of FY27.
So we have accelerating AI revenue and record margins, which honestly brings us to the valuation puzzle. A reverse DCF model is just a mathematical tool we use to see what growth rate the market is currently pricing into a stock.
Right. It works backward from the current share price.
And right now, it shows something absolutely crazy. What is the market actually pricing in?
Well, the reverse DCF implies a negative 3.1% compound annual growth rate for free cash flow over the next 10 years.
Wait, negative 3%. How does the market price in a 3% annual decline when management's stated FY30 revenue target is $63 billion?
It's a huge gap.
Yeah, I mean, hitting that target requires an 11% compound annual growth rate. The disconnect between those two numbers is massive. Why is the model so broken?
It basically comes down to a mechanical distortion on the balance sheet. To fund that $25 billion share buyback, Salesforce issued debt.
I see where this is going.
Yeah, that temporarily flipped them from having a net cash position to carrying $14.7 billion in net debt.
Right, so think of it like taking out a massive mortgage to renovate a house. Your personal balance sheet looks heavily indebted on paper right now.
Even though the house is ultimately gaining value, exactly, that temporary debt load artificially bloats their enterprise value, which mathematically just forces the reverse DCF model downward.
So the critical echo for you to take away today is that structural disconnect. I mean, you have fundamental, explosive growth in Agentforce, Completely at odds with a mechanically depressed market valuation.
Exactly. Which really leaves you with this provocative thought to consider.
What's that?
Well, if the pure math suggests Salesforce is undervalued right now, even if they never grow another percent, how aggressively might the stock re-rate once that buyback debt clears?
Oh, wow. Yeah, especially when their steady state cash generation shines through again. That is a fascinating disconnect to watch.
It really is.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prep. Catch you again soon.